He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She'll soon be quoted on the front page. Business Standard. He's making his investments talk. Business Standard.
Customers want decisions fast. You need them to be accurate. Delivering both requires reliable, timely insights. At a time when disruption is high, the future is unpredictable, and everything is digital, organizations must make real-time risk decisions to approve loans in an instant. Otherwise, customers won't just be frustrated, they'll take their business elsewhere. It's time we reimagine how we make decisions. Welcome to redefined risk modeling and decision-making for a digital era. Taking loan requests from application to approved automatically without increasing risk, to create a world-class customer experience. How do we do it? A comprehensive decisioning platform that supports the full analytics lifecycle, from data preparation to model development, validation, deployment, decisioning, and monitoring. Create open, explainable models in a well-managed and controlled environment using AI and machine learning. The result is your workflow gets simpler. You make faster decisions with better data, and rest easier knowing governance and auditability are ensured. For you, SaaS works behind the scenes to make the decision process faster with less risk. For your customer, the loan application is seamless, fast, and efficient. Make the right decision with less risk in every moment.
Good afternoon, and welcome to the second session of Business Standard Presents De-risking the Risk Business in association with SaaS. Last Friday, we had a detailed look at the new Indian banking landscape, how it has evolved through the pandemic. And today, We will discuss reimagining customer experience in new lending models with some leaders in risk management. Just to remind you, through the series, the biggest on risk management in BFSI, we are decoding the anatomy of risk in banking and insurance sectors. 3 more sessions to go over the next couple of weeks. Thank you for being with us. You're watching this on the website and Business Standards social media. Those logged in on bs-bfsiriskmanagement.com, please type your questions in the box given. Our host will ask some of them to the panelists at the end of the discussion. And on that note, let me introduce him, our consulting editor, Tamal Bandyopadhyay, and request him to start the session.
Thank you, Manish. Hello and welcome to the second event of Business Standard 5-event series, De-risking the Risk Business. We are talking about Indian financial system. Today, the topic is reimagining customer experience in new lending models. Now, we can't reimagine customers' experience without the bankers, because it's the bankers who give them the experience. We have a very interesting panel. Dilip Mirza from a public sector bank, UCO, two of his peers have got merged with others. So that's the only bank on its own from Kolkata. Then we have Bishajit from Bandhan Bank, a private bank, India's first microfinance getting into banking. While Dilip will give us a sense of what's happening in in corporate India as well as retail lending, Bishajit covers a different landscape altogether, mostly MSMEs and SMEs and individual retail MFIs, etc. Then we have another interesting person, Saurav from Centrum, which NBFCs. NBFCs have, apart from saying that they do play a very critical role, they're doing a lot of interesting things during the COVID time. Ajay Jha, I can't see him. Ajay is there? I think there is some issue with his technology, but Ajay is there. Ajay comes from a bank, IDBI. We call it a hybrid. You may call it a private bank. You may call it a public bank. It was into project financing in a big way and corporate lending, but now it is into retail as well. And last but not the least, we have Pradeep. Pradeep is from SAS, is a global firm which is into analytics and data mining and helping banks globally in the new landscape, how to navigate the new scenario. So welcome all. Rules of the game is this: I will speak the least, and because the audience, we have hundreds of people have logged in, will be watching you, are watching you. They will hear you. So my job is the facilitator's job. I'll just have a brief of put the context, and then you people will talk. We'll try to have a few rounds, as many as possible. So be brief. That's it, nothing else. Say about a year back, probably if we talk about, Ajay is back. Ajay, I've already introduced you, Ajay. So no worry. Say about a little more than a year back, had we have this chat in January 2020, the scenario was pretty different. No? Banks are confident, their NPAs were going down, they were capitalized, and their so-called provision coverage ratio also was going up. Things are pretty good. All of us were thinking that the first phase of NPA recognition is over, and now it's recovery, and they were recovering pretty well. And then COVID came and things have changed. I would not like to repeat, but both Reserve Bank of India and Government of India done its bit. We have seen moratorium for 6 months for the borrowers. We have seen Reserve Bank of India bringing down the loan rates to its historic low. We have seen Reserve Bank of India opening up various liquidity windows LTROs and TLTROs, so on and so forth. We have seen the government coming out in phases, the Atmanirbhar package. One of the key component of the package was 3 trillion rupees refinancing or financing, whatever you call it, with government guarantee. And to the best of my knowledge, 2.5 trillion have already been sanctioned. Over 2 trillion has already been disbursed. And as we were thinking that we are getting over it, banking system has showed its resilience. It's pretty good scenario, not as bad as RBI had projected in its 6-monthly health check in terms of asset quality is concerned. Now we are staring at a sort of a different, much more difficult problem, the COVID 2.0. So this is the context. The bankers need to put their house in order, or go for innovations, use technology, and see how to manage their customers, how to manage their quality of assets, how to source loans. So that's the context. I just want to take 1 more minute to demystify 2 technical terms which will come in our discussion. One is AI, artificial intelligence, and other is machine learning. Often we loosely use this AI and machine learning. So what are these things? I am not an expert, so I don't know the gender of Google. Somebody called Google auntie, somebody called Google uncle. I just picked up from Google. So what is it? Machine learning is a branch of artificial intelligence. Okay, computer scientist and the machine learning pioneer Tom M. Mitchell said, machine learning is the study of computer algorithms that allow computer programs to automatically improve through experience. Very often, we use this as interchangeable terms, but that's not the case. Machine learning is actually a way of achieving artificial intelligence. So it's a part of artificial intelligence. And then what is machine learning model? This explanation is like that. Suppose Vishwajit loves songs, so there are many songs Vishwajit enjoys, and then I get to know this, and then I have corresponding audio statistics. And after that, I can offer Vishwajit the kind of songs what he always loves to hear. So that's machine learning. Artificial intelligence, which is a term coined much before 1956, it's a much vaster in scope. And the gentleman who was called is actually very influential in that space. Andrew Moore, a former dean of the School of Computer Science of Carnegie Mellon University, says artificial intelligence is the science and engineering of making computers in a way until recently we thought required human intelligence. So essentially, when computers behave like human being, like for instance, and it's always evolving. For instance, chess. A decade back or 2 decades back in the 90s, computer started learning playing chess, and now it's every computer you have inbuilt, it can play chess. So that's all now, and it's always improving. Right now in our everyday life, we have Siri and Alexa and Google Home. They are the classic case of artificial intelligence. Machines are behaving like computers are behaving like human beings. So, and unlike machine learning, artificial intelligence is continuously improving, going ahead. And machine learning is a part of artificial intelligence. We have SAS, Pradeep, he's a master of this, because SAS in 147 countries helping banks, holding their hands in this area of machine learning and artificial intelligence. So this will come again and again. So that's all. My introduction is over. Let's start with Ajay. As I introduce Ajay, you represent a bank which is sort of hybrid. We can call it private, we can call it public. You have the experience of project financing historically, got into a large scale corporate financing, but now you are actually more than 50% of your balance sheets is in retail, if I'm not mistaken. We are not talking about your bank, but generally tell us, question number 1 for all of you is this: how this pandemic has changed the lending business? What are the key challenges and how are you managing them? How are you managing the risk, measure the risk at this point of time? Ajay, over to you.
Thank you. Thank you, Tamal. The first question, taking the first thing, before I start, I'd like to thank Business Standard for the courtesy extended to me and inviting me in this symposium. I'd like to thank Standard and for inviting me here. First thing is how pandemic challenges are there. As you have already covered, in fact, you have made my task pretty easy. RBI has taken care of RBI and Government of India have taken care of almost everything, in the sense that at this juncture, what is required is not so much of the credit risk, though it is there, it is apparent in the behind the scenario. But what is more important is liquidity should be available in the market, and that RBI has ensured, so that there are defaults are limited. The second thing that they have done was to provide the moratorium. I don't know, long-term effect is still not very clear to me, but short-term, definitely it has worked very effectively and has helped the banks to tide over the rates, difficult times. I don't know, with the second COVID challenge coming in, whether they will again go for a second sort of moratorium. I don't think so. It will be very, very difficult to extend the same facility again. Now, the basic issue as of us for now is, as you mentioned, that we used to be a corporate banker. Our 45% of the book is still corporate, but there is not much of a demand. The better customers, better rated customers, they are hardly using their limit. They are, because as I said, the market is already sufficiently liquid and nobody is coming to the bank for asking for the funds. The retail side, though, if I compare myself with the rest of the market, we are not able to perhaps take up the challenge, because the market is showing some growth, reasonable growth. Though I am not very sure how good is that growth at this juncture, because when, unlike corporate, where your own cash flows of the project, company, etc., determine your pay, here the in the retail, main source of payment comes from outside the model. So it is basically income dependent rather than income generational ability of the person. It is actual income. So what happens is that with this second wave of last year, we have accepted that there was a decline. This year again, there is a projection of 10.5% growth to 12% growth. But two things. One, that this is on a lower base. First thing, that it is more not a growth. In fact, it is more or less a recovery. And the second thing is these projections never factored in the second wave. So the second wave can again hit. And then so many cases where the prime, who were supposed to be the prime borrowers, may not remain prime. They may start declining. So risks are real on the credit risk front. Market risk side, yes, interest rate, RBI has so far managed pretty well. But I don't know, because now the linkage is international, and if FPI starts withdrawing money at a rapid clip, then how far we will be able to manage the liquidity. That's it for the time.
Thanks, Ajay. Thanks, Ajay. So, Ajay is talking about actually more macro risks. He spoke about how RBI helped and government helped, and now right now enough liquidity and other issues and all. So let's hear Dilip. We are Dilip, you are on mute. You have to put your this thing speaker on. Well, essentially, we want to know that how to de-risk your business from a risk manager's point of view. If I'm not mistaken, you did work in Hong Kong and Singapore, so you are exposed to the global banking. Now, tell us, I mean, normally the banking system, not necessarily your bank. What are the key? Ajay says that the prime borrowers will no longer remain the prime borrowers. So in terms of choosing the right kind of borrowers or maintaining relationship, how do you, the pandemic, what are the challenges at this point of time in risk management?
Yeah. Good afternoon. Thank you, Tawanda. Thank you, Business Standard, for giving me this opportunity to be here. Now, this, as you rightly told, the pandemic situation is continuing for last 1.5 years, almost 18 months. And financial and non-financial sectors have experienced a huge transformation. There is a monumental shift, monumental transformation, and time is very exciting this moment right now. And there's a lot of experiences we have gained due to the agenda given by the PSB reform agenda, the EASE, that is Enhanced Access and Service Excellence, which is the agenda of the DFS in consultation with the BCG, Boston Consultancy Group. The DFS is following up, and the IB is also coordinating. So, a lot of changes have taken place in the banking system. And then recently, for the year 2021 and 2122, the EASE core system is there. There is a digitalization of the bank. Now, apart from the core banking solution, what we have, they also we should also have the over the top technology over the core banking solution, and that is the loan management system, the loan originating system. Those changes we have seen, and we have also procured, and customer friendly the credit underwriting also we have undertaken. And the especially the Commerce Committee, they have recommended some reforms in the 26 sectors, especially the financial ratio, financial parameters they have relaxed. That is because of the pandemic situation. The moreover the that is the credit link guarantee scheme, the emergency credit link guarantee scheme, the ECLGS. That scheme also government has come out, and we the bankers are also implementing. We are also helping them. And apart from that, recently the concept is that the asset reconstruction company, ARC, or the bad bank concept has come up. That is also to help the corporate sector and also to the bank to reduce the provisioning requirement as well as to boost up the capital requirement. And more importantly, from the risk point of view, the credit risk vertical, the public sector bank which we have formed, the CRB, the risk parameters which the government has given, the 34 risk parameters, and accordingly the credit risk vertical also we have formed. So whenever any proposal is coming from the risk point of view, we are analyzing them, and then the from the risk department it is going to the business department to take up the proposal. Apart from that, when you are analyzing the risk aspect, the risk-based pricing model also is very important at this juncture. The risk-adjusted return on capital, that also we are assessing, and corporate level also risk assessment also we are doing. So the different credit rating modules, that recalibration of credit rating module is the one of the public sector banking reform agenda which was there. As for the requirement, the external rating agency and the internal rating agency, there is a huge differences. The notch differences we have to minimize, and for this purpose, recalibration of the credit rating visiting module, that also we have done, and we are doing also. And according to the industry wise, the segment wise, how the industry wise, segment wise, how they have been affected due to this pandemic situation. Those factors are incorporated inbuilt into the credit rating module, and those credit rating modules are also backtested and being rated by the top rating agency. That also we are using, and especially the purpose is there should not be any differentiation in the risk assessment between the external agency and the internal agency.
Okay.
So
Thanks, Dilip. You have actually given a lot of inputs for our discussion, and essentially what you are saying that it's not the bankers alone who are the managing the risk. Even the external agencies are there, and particularly the government of India. You spoke about BCG. They have also created model and all. So let's hear Pradeep now. We have heard two bankers, and I'm keep the other banker Vishwajit and Saurabh from NBFC later. Let's sandwich Pradeep in between from SAS. Tell us from your global experience, how has been this banking sector coping with the new risks during the pandemic?
Yeah, thank you very much, Taman. Right. So as again Ajay and Biswajit sir has correctly pointed out, there has been a significant increase in digital transaction, right? So what we have seen is even before COVID, the volume of digital transaction has grown upwards of 20% per annum for the last 5 to 10 years. In fact, it's somewhere around 35% per annum for the last 5 years. So in a sense, most of the retail side and corporate side and MSME customers, they are getting digitally savvy, right? And this trend is expected to grow further. And what happened during COVID is there was an actual push, an external event pushing most of the customers towards digitization. The banks were forced to move most of their operations and processes to digital platform, right? The last bastion of this traditional processes, which was consumer lending, was also then eventually moved to digital banking, right? This has been happening globally, but in India, what we have seen is India is actually leading the globe in terms of the amount of digitization, the way the payment banking is picking up, the amount of comfort customer has doing an online transaction, right? Uh, Again, one more impact of this COVID, and it has been a systemic impact, is that retail lending, especially retail lending, has been moving away from banks to NBFCs, and now that segment has been moving from NBFCs to fintech. Right, majority of the volume or majority of the transactions now happening at a retail lending space, they are moving towards more agile and smaller firms, right? And this is being driven by innovation, right? Because there is a lot of digital transaction, payment banks have a lot of data points which were earlier not available, right? They have new channels for reaching out to customers, and this has given them an edge in the modern digital led, I would say, advanced modeling space, right? This kind of pushes banks and NBFCs to innovate their life cycle management, and we have seen banks respond very strongly to this, right? Um, as again, our eminent audience have already, panelists have already told, even the traditional banks have moved towards digitization, towards modern lending practices, right? They are implementing more advanced analytics-based models. They are bringing in more digital technology. But again, this comes with its own set of challenges, right? With new channel, with new models, with new type of data and customers, the risk management practices also need to evolve. Uh, Model management becomes a critical function now, given that, as we have seen, machine learning models are known to be opaque, they're known to be black box models, right? So governance and management oversight must be strengthened significantly. And what we have seen is, for this aspect also, again, advanced analytics and machine learning plays a significant role, right? To just summarize quickly, globally, this is what we have seen happen. More and more banks are moving towards digital space, right? This digital revolution is happening, but the thing is, it's an opportunity that hasn't been fully tapped, right? To truly serve the customers, a new perspective need to be uh, arrived at, right? A new type of data, new type of models need to be developed, new type of infrastructure is required. And this kind of provides banks, NBFCs, and other financial institutions a brilliant opportunity to grow and capture this niche market.
Thanks, Pradeep. Yes, digitalization and actually the globe is learning from India, particularly what's happening on the payment space. We are the most happening space as far as the payment space is concerned. Nandan Nilekani had recently said that what could have happened in years, now it's happening in weeks. So we'll come to that later, but let's stick to our first round. What you're talking about, the new challenges. Let's hear Saurabh. Saurabh, tell us, Pradeep made a very important point. He says that from banks to NBFCs, now NBFCs are losing out to fintechs. And also, of course, we are seeing that the more alliances are being forged with banks for the co-lending model. So tell us, in this entire, against the backdrop of COVID pandemic, as an NBFC, how things have changed when it comes to risk in credit assessment and management.
Thank you, Thomas.
Sorry.
Thank you for inviting me. Basically, the way an NBFC always functioned was to be able to lend to customers which were deaf, which were not traditionally going to banks. And second, the quality that an NBFC always possessed was agility. Now, both of these factors have actually helped NBFCs adopt adapt to the requirements of the current market scenario. The pandemic has basically led us to a situation where we need to go into more and more digital kind of lending, as Pradeep pointed out. So for an NBFC, the entire value chain, which is what do we source, so the sourcing, how do we assess, so the underwriting, how exactly do we do the documentation, how exactly do we create a repayment schedule, and then how do we do collections? All of this has undergone a complete change. One, because of the fact that there is more and more tools which are now available in the market where you can change the customer experience to a branchless formation. So no longer do you require the customer to come to a branch. You are sitting at a particular place where you know for a fact that there is a database which is available to you, which authenticates the fact that this is a particular customer which works in a particular segment or a particular sector. So you've decided, for example, let's say that Kirana stores are going to be your target segment given the lockdown, because these are part of the essential services at this point of time. Now you have databases which give you Kirana stores by the area, by the geography, by the pin code. You have so much of data which is available to you are the GS points, the banking or whatever are the loans, whatever is the banking that customer undertakes, what exactly are the credit scores that he's running with other institutions, what exactly are the behaviors that he's displaying on his social media platforms, what exactly are the behaviors that he's displaying with his wallets. All of this data is pretty much available today for you to create a scoring model which will help or guide your credit risk underwriting. Moving from there, we have now a system which there is more and more acceptability of documentation without wet signatures. So you can move to a particular situation where lesser and lesser amount of wet signatures are required. And I'm now given to understand that, other than a mortgage document, we can do away with wet signatures almost everywhere else. That just helps us completely change a customer's experience with the bank, the ease with which he or she can actually avail a particular loan. Moving on to the repayment schedule. So today I am in a situation where I can look at a customer's daily cash flows. So Ajay also had a very important point that income is the more important thing. So that cash flow of a particular customer is the most important thing when I am doing an underwriting as far as retail customers are concerned. There is so much of data which is today available in terms of how exactly is this income working. So there is GST, there is banking, there is the wallets that he's using. What exactly are the presence that he has with online banking, Amazon, and for example, the other online platforms, what exactly he's running with them. All of this information is pretty much available for me to run very simple analytics or very simple coding with a tool like Excel to be able to figure out a trend line. And then as an NBFC, because agility and because of the fact that there is flexibility available to me, I can schedule a repayment schedule which is going to be suited to the needs of the customer. So if this is a Kirana store which has daily cash collection, I can just simply move on to a daily recoverability or daily amounts that need to be repaid to me. And similarly for collections, collections don't really now need for a collections officer to go to the person's place and then collect something. It is just a simple NACH mandate. I am tracking the cash flows of the customer. The moment I see that there are cash flows in the customer's accounts, I can activate NACH mandates and recover my account. So as I said, the entire value chain has completely taken a complete change as far as the
Thanks.
pandemic is
Yeah.
concerned, and we've had to respond.
Thanks, Saurabh. So it's data, data, data. Data is the new oxygen for the entire banking system, if I may say so. Vishwajit, you are the last speaker, and I've kept you last for the purpose because you represent something. Your interface with that particular segment, the informal segment, which is very, very critical for the economic growth. You have millions of customers, SMEs and MSMEs and all. So can you tell us in this COVID time, how do you, because traditional model of MFIs from where you have become a bank is basically a more touch and less tech. But now in this scenario, Tell us what is the new risk model that you are, or what kind of models that you are following?
Thanks, Tamalda, for organizing this interesting discussion. Before that, before coming to your specific question, general way I will say COVID has actually changed the concept of risk management itself. I will give you a very simple example. Like what used to be the risk mitigant is now the risk itself, or the otherwise. One simple example is mask. Previously, have you worn a mask and walked into a branch, they would have put on the alarm. Now, if you don't put on the mask and walk into a branch, they will put on the alarm. So this is one of the points. Second point, some of the things we have lost. And that means some of the things was lost. Actually, Pradeep is there. He can actually tell us very well what was the number of time vaccination was such during last 2 decades. It must be NAV. So we used to think virus can impact only the computers and those digital channels and others, not the human beings. So the etymology and the nature of the risk has undergone a change. Along with that, if we go to the, because broadly the concept of risk remains constant. If I go back to the 5 C's, and then I will come over to the segment, which will be across the segment, but more pronounced so in the segment which our organization serves more. So if I talk about 2 C's, one is the character and one is the cash. Now, COVID has brought in a situation, it is very difficult to understand on which front customer is going strong and which front he is not. Let me give you a simple example. Now a moratorium was given to a person who is working from home and getting all the salaries. How do you track him? Means exactly actually going forward when you make a scenario building, whether you will take it as a disinclination to repay or the capacity to repay. So these are the 2 things which I was trying to tell. Now coming back to the segment which is actually very touch-based. Now touch as such has got a gone topsy-turvy, because you must be knowing now if somebody requires comfort, you cannot come near to it. So if you touch him, it becomes discomfort. So with that in mind, let me tell 2, 3 things. First part is that the way we talk when we talk about touch, the touch can come in 2 ways. One is the touch is because you have to know actually what is happening. Because what is beyond the data, you have to understand it very clearly. So, and then I take it to what exactly is the way forward. The impact has been too much. Now that necessitated the requirement of capturing the unstructured data, because the data lies there in this type of customers all across. So what we will be looking for, I think, or this segment will be looking for risk mitigation for some things like data lake, which actually can utilize the unstructured data in a proper way and get the output. Because ultimately, when we have to look into the C's and arrive at a number, then we have to be very clear. If we have to do scenario building, we have to be very clear exactly what it is. It is the character or it is the cash which is getting impacted. If I give you a simple example, we made a lot of visits. Actually, January and February, I visited more than 50 villages in Bengal. Find out the impact. What is the impact on the livelihood and what is the impact on the intention also? Because the government and others gave also a lot of succor during that time. So how much of it is as a good risk mitigant they have kept for their more rainy days, which has again come in. Maybe they have conserved their capital as a customer also to come back to it. And second, we have seen livelihood got disrupted and they are coming out about alternate livelihood. Now, technically, banking sector or financial sector actually recognizes only the repayment. It doesn't actually, no way we can measure the intensity. That is a risk we have to take, because compliance wise, if I have to, I cannot go and say this person has got an intention to pay, so it should not be converted into a NPA and all these other option to get more credit access can be stopped. So these are the certain points of things which we have to take it out, where we think, as I was telling, a whole lot of transactions data and others are available. What is not available is what is going beyond it. So if I say somebody has to pay X rupees of an installment, and if he is paying X minus Y rupees, then how do you know that Y rupees is because of his income impact or his inclination impact? Third point, which actually this system has, this sector has always worked on, because here operational risk and credit risk is intermingled. So apart from the normal models built upon financial risk, I think the scenario buildings and this type of things are making more important, has to be taken more seriously. Like for our side, if you ask me, there has been impact of socio-political events and others. We have over last 5 years using this is one of the things after we become a bank, we started utilizing it, building up scenarios, putting stress testing, impact of floods, impact of riots. Now, similarly, it is the mother of all impacts, the pandemonium. So we have tried to build up certain things onto it with a mixture of your structured and non-structured data, but where the non-structured component will be much higher. So it is in a way how much we are trying to convert the uncertainty into risk in a analytical basis.
Okay, thanks, Vishal. I think you have pointed out a very interesting thing, that how do you assess the inclination part, which data can't capture. We'll hear Pradeep later on that, but let's have this round purely on digitalization. We'll start with Dilip. Dilip, you worked in, and Vishwajit, you were with ICICI, if I'm not mistaken, before your current assignment, right?
Yeah, almost 2 decades.
Yes. Yeah, 2 decades of ICICI, and now we are with India's largest MFI turning into a bank. Now, this round, let's talk. We are getting a lot of questions. I don't know how many we will be able to pick up, because our time is limited. We have almost half of it we have already finished. So let's make a quicker thing. Dilip, starting with you, you put on unmute. The entire digitalization. How are you tackling? Because till about before COVID, we used to say HDFC Bank is 87% or 92% digital. That's the biggest one. And now if you talk to almost every bank, says 90% plus is digital because of COVID and all. So it has its pluses, it has its minuses. So Dilip, can you take us through what are the challenges of digitalization, particularly in the credit assessment, monitoring and underwriting? Yeah.
In the digitalization, especially we are experiencing the fintech companies they have come up, and with the fintech company, the partnering with the fintech company is a real challenge, because there's a fintech means the financial technology. The difference is that the bankers, we do not have that much technological support what the fintech companies they have, and on the other hand, the fintech companies also they don't have that much customer base, they don't have the capital base, so they also need the banker. So the partnership between the fintech and bankers is very much there. But in our system, we have digitalized especially the personalized banking services, the retail banking services that we have different loan hubs, the retail loan hubs, especially the agricultural loan also, that is technology based, and retail lending also we have created retail loan hub, and to meet up the requirement of the BCG guideline, the ease requirement, different retail loan hubs we have converted. Then another thing is that the early warning signal for the credit monitoring perspective, which I have not mentioned, that is also totally now the system driven, and the system driven also the credit rating, credit assessment, even the credit underwriting also now quite system driven now.
Dilip, can you tell us, without naming the customer, anything, any interesting anecdote in terms of early warning and all, which has actually helped you because of digitalization? Is there anything you can share, any of you, during your course of thing? Don't need to breach confidentiality, but just for the audience to understand,
No, actually The digital banking, we are doing it. We are going through it, but the risk is also there because the what you have done, data protection, the data, especially the data protection area, and the three areas: the known to known, or known to unknown, and unknown to unknown. When we are in the traditional banking, when transformations have taken place, and the earlier the traditional banking, we bankers, we used to know our customer used to know the banks. Now the banker, they are going to the unknown areas of the fintech companies, and fintech company, how to whom they are sharing their data, that is unknown to unknown area. That part we do not know. That is the risk area. So then that part also we have to, because this cloud computing system, cloud space, which are now being used, and the rapid transformation being taken place. So now the time is very much exciting and interesting to see how this digitalization will be successful. But so far the risk is concerned, of course the risk is there, and this unknown to unknown and known to unknown area risk also we have to cover up.
Thanks, Dilip. So essentially, banks are fintech. They are forming alliances, and if I'm allowed to use a jargon, I think the OTT model, that over-the-top model, banks, infrastructure, and fintechs are riding on that. So Ajay, your turn now. Can you tell us that when it comes to digitalization, where are you? If you want to give us a sense that what percentage of your transactions are off the branches through and ATMs through digital, and how is it you're helping in terms of credit assessment and monitoring?
Two things. First, so number is somewhere around which everybody is reporting. We are higher than 85% because of course, this is added by COVID. A lot of people prefer not the branches.
Of course. Yes.
But in the case of digitalization, I like to mention, actually, we talk digitalization as one entity. It is not. There are three aspects: deposit taking, payments, and lending. Now, digitalization across these three services vary. In case of payment, because web-based or e-commerce payments are much higher, it has grown up like anything, and everybody has indicated that. In case of deposits, yes, you can still take money through that. But in case of lending, the the digitalization, that is going to create the biggest impact on the bank, because it is the asset which is the source of income which is going to get affected. And there we are talking in terms of data mining, deep learning, artificial intelligence. But I have, as a risk manager, I'm not talking as a representative of a bank. It worries me, because earlier appraisal models, what was happening was that there was a causality between, as Vishwajit has pointed out very clearly, that how do I find out the intention? But the point was, earlier models where you sit across the customer and talk to him and see, you establish a causality in your appraisal. Here, what you are going to do is looking at his social media profile, looking at his payment records and everything. You are basing your decision on correlation. Correlation has a tendency of crashing in case of a serious situation like current pandemic. You will find that those correlations no longer work. And if anyone who is lending based on those numbers, he is going to, like I'll appreciate Saurav's point there, that he said, yes, challenges are there, because you can't, he has emphasized one point very clearly, that machines as yet are not able to replace the human understanding. Just on a lighter vein, those of us who have read P.G. Woodhouse, the lending was across whenever this poor friend of mine, what is his name? Bati. I forgot the name is not coming. But Bati Wooster, he needs some money. He simply goes to the bank and manager immediately extends him without any question asked. Why? Because he knew him personally. He knew that this guy is a good creditor. Now, same thing is happening through the digital channels. I decide based on certain parameters, based on my experience, based on staff experience across the world, and based on other people's experience. I am deciding that, okay, this guy is a good credit risk. But I am forgetting that going forward, time may not remain same and the correlation may break down. So
Okay. Please.
One thing I am really worried about as a risk manager, when people very come and very proudly they announce that we are lending through without touching this thing. I want to remind them that even Verti Booster was getting within a second. 30 सेकंड तुम्हारा टारगेट है उसका अभी तक 30 सेकंड से कम में मिलता था उसको. So it is not. Lending is ultimately three things, boss: principal, price, and period. How much money you are willing to lend, how much price you are going to change, and for what tenor. That remains as it is. Based on correlation, I don't know. Oh, the weather is good, people are making money. I will not stop my bank from doing this. I will not stop any other bank from doing this. But as a risk manager, I will be keeping a very, very close eye on this. That where the correlations are start breaking, I'll immediately start now time to deal it. That's it. Thank you.
Thanks. You have your worries. Vishwajit say that how do I gauge the inclination? You are saying, yes, my worry is this: today he's fine, but tomorrow if he acts differently, we'll hear Pradeep all these things. How can he help the bankers to map their behavior through data? But before that, we need to hear Vishwajit and Saurabh. Vishwajit, on digitalization, quickly, a couple of minutes, if you can tell us.
Okay, I will just pick up one or two things actually.
Yeah.
Since you spoke about my love for song, I know, knowingly or not.
Yeah.
But I say only one thing about digital. There was a Hindi movie song long ago. It spoke about money. कि पैसे की अहमियत से तो इनकार नहीं है. पैसा ही मगर सब कुछ सरकार नहीं. So I am saying same thing. Digital की importance से इनकार नहीं है. But digital नहीं हो सकता है. Means what I am saying, digital is okay. Work with one L. If it happens digital, it will be very difficult. And Tamalda, there is a this thing. If you allow me, I will say it is a practical experience I got.
Please.
During my last stint, where we were very active on to it. And this auto renewal process we have done for small size unsecured loans. And it was working very well. Till the time I went for a visit in Ahmedabad, not Ahmedabad, or Rajasthan. And I found it is the son of that person who has taken the loan 5 years ago, which was getting renewed every time, who was readily making repayment, and it was going on. So while repayment is okay, again, whether the purpose was lost or not, so that made me this thing. Digital, it is a very good actually input, but finally, as Saurabh said or Ajay said, I don't think human intervention will be actually totally obliterated. So again, I say, with a single L, I am all for it. With double L, I am a bit worried about it.
Okay, let's hear Saurabh. Saurabh, you are the person who actually, of all the bankers or the finance professionals in the on this panel, you are the person who said at every stage you are using data and digitalization. So can you tell us the pitfalls of they have raised that you don't know person's intention, whether he wants to pay even if he has money, or if the person changes tomorrow, and also how do you manage those through data crunching and digitalization?
Thanks, Tamal. Tamal, you actually wanted to talk about anecdotes, and both Ajay as well as Biswajit talked about music as well as Bertie Wooster and everything. I just wanted to tell you that, see, there is a lot of data crunching which is happening at this point of time in the world of intention. Just to kind of allay this whole fear, data trends are, it's just talking about the fact that there is a correlation that you're being able to draw, and correlation happens to be the most basic tool of statistics. And I've kind of done my BSc in statistics, so I kind of know that that's the first thing that they teach you in first year itself on. So this is just simple basic mathematics. Now, just to move on from here in an anecdotal format, data today tells you that if both the husband and the wife are educated, there is a higher tendency of loan repayment happening. Okay, but data also tells you that if the wife is more educated than the husband, there is a likelihood of default. So that's just data trend lines at this point of time. I'm just saying this is something that I have basically confirmed with a lot of other fintech lenders also, who've looked at data that of lenders that comes to them. And this is a very funny incidence that I got confirmed from 2 or 3 other fintech players in the market. That again, I'm going to repeat this: if both the husband and the wife are educated, the chances of repayment become much higher. If the wife is more educated than the husband, there is a better likelihood of default, or a higher likelihood of default. Now, what do I do with this data? What am I doing with this data is just basically, uh, I am just taking this set of data and I'm doing a segregation mechanism, or I'm coming up with a segregation. I have targeted a set of customers where we pointed out a lot of problems, such as data not being consistent, data not being available, data being fragmented across a lot of things. So therefore, segregation of the correct customer through this filtering mechanism is the best way that I can actually improve my sourcing, right? So these are all methods and methodologies of segregation of the right customer. The moment you start segregating the right customer, you've reduced your risk by a huge percentile. Now, once you've done that, and then you move into the actual data which is available. So today, if let's say Saurabh Srivastav is a person who is ready to repay his home loan, is ready to repay his car loan at the appointed date, at the appointed time, without any delays, there is less likelihood that if Saurabh Srivastav has taken a personal loan, he will want to default on it. So those are the data points that one is actually utilizing and drawing very simple correlations. No, there is absolutely no rocket science involved out here. I'm just taking a simple data and I'm saying, if you've defaulted on another loan, there is a high chance of you defaulting on my loan also. So it's just a customer segregation process to reduce or filter out the kind of customers who show behavior which is actually points towards delinquency. So that's the methodology that is used in terms of digital lending. Now, that's just to answer what exactly is the whole process about digital lending. You have today streams and streams of data which is available to you. So for example, if there is a client who is defaulting on, let's say he is a delinquent customer with me. Now I have data today, I have access that this is the amount of sales that he's doing, let's say on Amazon or on other online platforms. I can actually reconfront that customer saying, this is the amount of sales that you actually have through these platforms. Why exactly are you telling me that you do not have the cash to repay me? So that's a risk mitigation tool which is also available. So data, while it has its own pitfalls, and I do kind of agree that we haven't really reached a place where there is a customer who comes in, puts in an application, and a machine looks at it and says yes, done, and then there is cash that comes out of a particular slot and then he takes it and goes away. So that's something that we haven't really reached. There are people who are looking at it constantly. There are people who are looking at it in terms of who to segregate out and to make this more and more risk averse, if that was the term that I might use, please.
Okay, so thanks. Very, very interesting statistics and very interesting anecdote you gave. So let's hear Pradeep now. You are the last speaker on this round, and we'll probably have time only for one quick round more. So Pradeep, tell us. You have heard all these things. So tell us, what's your advice? How do you handhold them? What do you offer them? I mean, as an advisor, as a data analyst, and a firm which basic strength is machine learning and artificial intelligence. How do the Indian banks tackle this?
Right. Thanks, Taman. There has been quite a few interesting points that have been raised, right? I would start with Ajay sir's comment that, okay, the correlation changes, right? This actually is a very important aspect that banks need to consider, that, okay, even correlation, or for that matter, any, let's say, mental model that I have built with the customers might change when the macroeconomic scenarios change or when the global situation changes, right? So that model which was working till yesterday, right? Be it the most sophisticated AI/ML model or be it a simple, say, scorecard-based model, that might not work today when the whole globe has turned upside down, right? So managing the risk of the model, the efficacy and efficiency of the model becomes very important, right? And for that, we would again, time and again, even the regulators, even all the governance bodies have been pushing that you have to have a proper model risk management in place. You have to have a very strong governance in place, right? So that is something that, yeah, correlation will break. It has the property of breaking time and again, right? This is something which most banks need to keep their eye out for, right? And second, of course, there is a, I would say, issue with machine learning or an AI/ML kind of model where it tends to be a black box model. There is lack of interpretability, or there is lack of explainability, right? So that's a very valid point that has been raised, and of course, that is one issue that, say, a bank need to overcome to actually effectively adopt AI/ML lending, right? They can't just put data, some number comes out, and then they follow that number without thinking, right? Uh, there are techniques, and most of these techniques are based on statistics and experience on how to mitigate those, right? Again, this goes back to the age of, uh, goes back to the concept of governance, right? Understanding what are the linkages and interpreting these models, right? So instead of going with a black box model, what the banks can do and what the banks have been doing is getting more and more data, understanding the customer behavior better. And this is possible only by, again, what Saurabh was mentioning, right? Segmentation. We need to have the proper set of segmentation. Today, it's the age of what we call as micro segmentation. We arrive at the smallest possible segment of customers. And again, to do this task, there are machine learning models that banks have been using to segregate the customers properly into the right bucket. And second is hyper personalization. Again, as Saurabh was pointing it out, like, there are a bunch of customers, they are in this segment, their behavior would be unique. It's the job of the banker to identify this behavior and treat the customer accordingly. What the machine learning model won't do is do the, what the machine learning model lacks is the last stage, right? It can do a segmentation, it can arrive at some conclusion, but it takes a human being to do that task, to service that customer, right? So one way of looking at that is that, okay, this is a tool, and it's a tool that a human being, a trained banker, can use effectively to cater to the customer's need, to cater to the customer's requirement, right? And of course, one of the biggest challenges that lies, especially for digitization, is the reliance on uh, open source model, and another risk that comes with it is the key personal risk, right? There is a lot of knowledge and insight that resides within a person or a set of team members, and that is something, if not codified in the operation, if not documented properly, would be lost, right? For example, we have seen models that have been built which are like massive 10,000, 20,000 line code blocks, and the person who built that model has left the firm now, and there is no documentation, there is no testing, there is no further development possible. Even though the model is not as efficient as it was few years ago, the financial institution is not confident of changing that model because they are scared of breaking that model, right? So these are some of the risks that banks have to overcome, and there are ways of overcoming this. Let me just quickly come to that, right? Again,
Yeah, fast. Yeah.
yeah, right. One is, of course, the data management capabilities need to be brought into place. Proper data historization, proper database management should be put in place, and more focus should be put on model management, model governance, and workflow control, so that documentation is there, all the inputs, all the assumptions are tracked and recorded, and whatever happens in the model need to be recorded for posterity. Right? These are some of the ways which bank can handle the risks that come out of digitalization.
Thanks, Pradeep. We have actually many questions coming, but before that, we just have a quick 1.5 minute each, probably because we just about 5 o'clock, we will with the permission of all of you, we just have another 10-12 minutes more. So tell us, we discussed the challenges, we discussed the stress during the COVID time. Each of you can tell us what is the silver lining, what are the lesson learned, and you will become a better banker, handle it in a better way. We'll start with Ajay. 1.5 minutes, sir.
One thing I'll not even take half a minute. I'll tell you one thing.
No, tell you.
What has taught us to be ready with any eventuality. Whatever you are reading in the book is not sufficient. Keep your eyes open. And systemic improvement, that something Pradeep has talked about, that manage your models properly. This is what we are going to do. And I hope that others also do that.
Dilip?
Down the line, next 5 years, I can visualize that digital banking is a call of the day, and we have to go for it. The both financial services and non-financial services we have to cover through digital platform. And the traditional banking, what we used to the KYC. Now the KYC is not sufficient. We also have to know the KYE, know your enemies. And what we used to know what we have been discussing about the machine learning and artificial intelligence, AI/ML. So the AI/ML is not enough. We have to also know the AML. We should not forget that is the anti-money laundering issue, which is inbuilt in every transaction. So these are from the risk management point of view, my observation.
Yeah, Vishwajit, we are seeing stress, we are seeing challenges, but what are the key lessons learned, and what is the silver lining?
The key lessons, I will agree with Ajay, is that anything can happen. Anything is possible. Nothing is impossible, and we should be ready for the eventualities. We cannot ignore the tail side of the things. Even extended tail, we have to go for it. That is the first part. Silver lining, again, I will say, is coming from my visits which I have made. In spite of such a thing, I say a whole lot of optimism into the human beings all across. Where I went to the lower strata of the society, and there is a huge amount of optimism, which after so much suffering, how it is there, that is the biggest silver lining. And my own view is that we should look into overall going forward. Another learning is that we should add the AI to our NI. So artificial intelligence and natural intelligence to get a comprehensive intelligence. So that is the way I think we can actually get over the things as humans has done across the ages.
Absolutely. Saurabh?
Refocus onto the cash flows of the customer, recustomize your collection mechanisms to the cash flows as they exist or as they continuously keep changing. And the silver lining is that today a customer is looking for ease. If you're able to provide that ease of contactless services to the customer stickiness with you is going to become much more higher. So the more the clients or the companies will customize themselves to provide the customer's ease, the better customer stickiness is what they're going to be able to witness in the times going forward.
Pradeep, you want to add anything?
Yes. So
after that, Pradeep, just to say that after you say, we need to take a few questions, others will be unfair to the audience. There are many, but we won't have time to take all the questions. We'll at least take a few questions. Sure. Yeah, Pradeep, please.
Yeah. So just to summarize what everyone was saying, that today we are seeing a renaissance in digital banking. We are seeing a new age, new era in banking, where because of the new technology and the new, I would say, circumstances, bank would be able to reach out to the customers who were either called as unbankable, right? The kind of loans that would be issued, the kind of products, the kind of target customers, they would totally change. And I could foresee a very strong growth for Indian banking, especially with the aptitude and with the inclination towards technology to capture this market, to serve the customer much better going forward.
Globally, Pradeep, since you are a global firm, I mean, how do you see how is Indian banking stuff is different from some of the other advanced countries?
To be honest, Tamal, here I think we can pat our backs. I have seen some of the largest European and American banks. They still are, I think, in many cases, 3 to 5 years behind Indian bankings in terms of services that they are providing, in terms of the quality of customer experience that they are providing. And this I would fully attribute to willingness of Indian banks to go digital much faster than the global counterparts. In Asia, actually, again, we see the same pattern happening. We are open for more newer products. Asian countries, Asian banks are open to more digital lending. So they again are on par with Indian banks. But
Okay.
all in all, we are
Okay.
doing pretty well.
Thanks. Quick few questions. They're all risk related. So I'm just picking up one. This I will ask Vishwajit, even though the questioner are not asking for any particular person, but I thought you are qualified to answer. He says that do government policies like the deferment of loan and loan waivers, etc., that change the customer's behavior? Is it a big risk?
Well, I think it is, I touched upon it normally. Actually, if somebody working from home getting full salary is also taking benefit of the moratorium, whether it is actually a sort of inclination or it is he is saving for his future, or it is difficult to know. So it is actually, while we are talking about looking into our model, continuing in our model, the model needs to be changed. Again to quote, हर घड़ी बदल रही है रूप जिंदगी.
Okay. Okay. This is a question I'm asking Dilip. How does one address the potential for exponential increase in financial frauds because of greater dependence on digital platforms? Dilip.
Yes, as I told you that there are some preventive measures available, and we should take all the preventive measures, especially the e-banking and the ATM card. Lot of frauds are taking place, and some measures are already, some vendors are available in the market. Some softwares are also available. That is the fraud risk management solution is also available. So with that, with the help of a FRM solution, that we can minimize the frauds in the digital banking area.
This is a question specifically for Saurabh. How does one factor things like the impact of COVID-19 on cash flows or the proportion of defaults that may be genuinely because of the pandemic or otherwise on your scorecards?
How exactly do you go about doing that? So let's just simply take a very simple example. What exactly is your banking input and banking output has a bearing on what exactly is the score that you're being able to develop, right? So if there is a typical amount of transaction that you're doing, or there is a typical amount of balance that you're maintaining in your bank account, that kind of has a bearing on what is the kind of score that you actually get as far as your credit score is concerned in terms of there obviously going to be an impact on what your credit score actually is. But however, what one needs to do at this point of time is that, as I talked about, customize. I have to start customizing what exactly is going to be the repayment collection for me. So for example, if you were a restaurant and I was collecting monies from you on a daily basis, maybe I can shift on to a weekly basis, because now at this point of time, you're no longer taking customers in your shop, but you're only doing deliveries. Deliveries would mean that all of these service providers like Swiggy's and Zomato's pay you after a lag of time, or deliver cash to you after a particular lag of time. So therefore, what I do is that I recustomize my collections module, and I basically start collecting monies from you on 7-day basis or on a 15-day basis. So that's exactly the customization that I need to bring about to take care of the impact of this particular pandemic. So I just give you a very simple example. This is something that can be extrapolated into various different segments and sectors and micro sectors.
Thank you. We have quite a few more questions actually. I have one last questions to all of you. I will start with Pradeep and end with Ajay, the reverse way. So tell us, I want you to list the in terms of priority, what are the key risks for the Indian banking system as the second wave of COVID staring at us? Like by February end, March beginning, bankers were pretty confident. They were saying that the actual bad loans and their pro forma calculation was not very different. In fact, they are all saying that Reserve Bank of India's projection of NPA by September 2021 is far higher than actual NPA. And that we are going to see for the year March ending, 31st, for the year ending 31st March. But scene has dramatically changed in April, the second wave. And now if you talk to any bankers in private, you will hear that how the system is affected. So I'll ask each of you to tell us, Saurabh, in your case, the financial system, not bank, because you are representing a NBFC. What are the 1, 2, 3, 4, 5, or 1, 2, 3 in terms of priority key risks? Pradeep.
Thanks, Taman. To start with, I would say it is liquidity risk, right? So even good business who have good prospect, they might run out of cash and they might go bankrupt. So pretty much that would be the most significant risk which the banking system, the entire financial ecosystem would be facing. Second key risk again would be the default risk. If the COVID continues to happen, good businesses who were dependent on continuous inflow from their customers, they might be impacted significantly. So those kind of either to profitable business, they might default, they might go bankrupt. Third, I would say is again the human resource risk, we might say, right? There might be a chance that bank employees again they are a critical resource and they have been running the show behind during COVID time also, right? Taking care of employees, ensuring that they are safe becomes critical at this stage.
Okay, 3. Saurabh?
So the first one that I would say is the customer engagement. Because of the fact that we're dealing with more and more retail customers, customer engagement was a very, very important factor in terms of lending. So that is a risk that we have to overcome. Second happens to be incorrect assessment of cash flows, because of the fact that this pandemic has actually changed the cash flow patterns of our borrowers. So therefore, that assessment has to be re-looked at and revisited. And the third happens to be for an NBFC, liquidity risk. Liquidity for NBFCs was scarce starting the IL&FS crisis. Pandemic 2.0, as Tamal coined it, happens to be another risk which will actually squeeze liquidity for NBFCs out of the market.
Yes, the bankers are listening to you. I'm sure they will extend a helping hand. Vishwajit, the key risks.
So people risk is the first key risk. People risk both internal, when I mean about the impact of pandemic on their health, and also on actually, how do I put it, stress level. Second, the similar thing for the clients, because what is impacting the staff is impacting the clients. So together I am putting them into people risk. Second risk is information security risk. The way we are moving into digital, and the knowledge of our, by nature, first about infosec is far away. Even normal thing where we require a police to put on the helmet. So our general things, not putting on mask, or general tendency to not be so cautious. This is the third thing. Third thing is, sir, I think default risk coming out of both of this, health risk, cash flow, etc., etc. And fourth risk, if you say market risk, I think because of the regulatory interventions also is
Sure.
to liquidity, etc., etc. Market risk also has to be watched very closely.
So, Mr. Midda, Dilip sir?
Yeah. Regarding the risk area, I can tell that the retail area, especially, we have to go slow as a GM risk, because of low income, huge unemployment we may experience in the coming times, and recovery would take time. So retail segment, especially, and we have also seen the Citibank, they have come out. So the retail segment, we may have to take a little care. The corporate segment, some of the financial parameters, we may have to relax. RBI has to come out with this. Some of the parameters like your liquidity ratio, debt equity ratio, turnover, somewhere you have to compromise to help the corporate. Next is the government should give sufficient capital support to the bank, so that hand-holding support bank can extend to the customer, to the corporate customer, especially the restructuring of the loan in line with the EC and their emergency credit line guarantee scheme. The hand-holding support also required to give the corporate and especially the MSME segment. So the restructuring formula and restructuring framework also government RBI has to think of. And fourth is the liquidity support. Sufficient liquidity support should be there. Of course, the repo linked rate of interest finance is there, and if the further repo further goes down, then that will have some macroeconomic impact also. So those part also government has to RBI has to think of. So these are my suggestions.
Okay, very demanding. Mr. Midda is very demanding. I'm sure RBI is listening to you. Ajay, the last word is yours. What are the key risks at this point of time for Indian banking system?
I'll say that information security is the most crucial. Here I am including even fraud risk, because online frauds are increasing. Though generally we don't consider frauds as a part of IS risk, but I think IS risks are pretty high with all sorts of softwares coming. The second risk I feel is basically the interest rates are currently almost at the historical low. They can go only one direction, and that is up. So the banks are going to take a big hit on their AFS and trading books, as well as this will also have an impact on the borrower's ability to pay, because borrowers are also getting pretty good rate as of now. And particularly supply chain getting adversely affected, because the global supply chain is going to get impacted by this, and rural demand is going to go down. So I feel that credit risk is also a serious threat here. That's it.
Thank you, gentlemen. 5 gentlemen for 3 bankers, one representing NBFC and one a consultant. We could have gone on and on, even though risk is, I would say, not so exciting a subject, but I thought we had quite an interesting discussion. So what are the key takeaways? There are many risks, right from as and when RBI start unwinding, that's the liquidity part, and then interest rate going up and everything else. Credit risk is staring at us. Also the human resources, that's a big challenge. What we have discussed is, if I may summarize, is well, the AI and ML, that is artificial intelligence, and the other part is the need of the hour to analyze the customer behavior, to appreciate things, how things are changing. But at the end of the day, we need to also understand what we are doing. I mean, we can't use the bank credit system like Siri and Alexa. I knock at the door for a loan, and you just tell Siri, give him the loan. It can't happen, right? So we all the human intervention will continue to be there. And interesting anecdote, the key finding, if you ask me, the key takeaway for me, what Saurabh says, what the data says that, well, if a borrower comes, a couple, and both of them are educated, chances of default are very low. But if the wife is more educated than the husband, chances of default are high. So I think we will end with this bit of a puzzle. Let the bankers go back and figure out why this is happening. Okay, so with this lighter note, let's end the heavy discussion on risk management in banking. That's the second of the 5 event series on de-risking the risk business. Thank you all for staying with us, and stay safe. Over to you, Manish.
Thank you, Raman. That's an interesting puzzle indeed. I wonder why. But thanks to all our dear panelists today for this insightful discussion. Thank you, SAS, for partnering with us. And thanks to everyone watching this. Our next session is on how getting cloud right is critical to risk management in banks. On your screens now. It's this Friday from 4 p.m. And if the insurance sector interests you, the next 2 sessions after this are on insurance. We hope to see you there. And that's a wrap from us today. Thank you. Please stay safe.